Before you get to the short answers, I was wondering if you could really give a high-level overview of cost segregation. Let's say I am a GP or
Sure.
I'm raising capital, and I want to explain macro accelerated cost recovery system. I want you to actually elicit my croc brain and make it easy for me to understand and make me excited about it, because it's not really an exciting topic unless you figure out, like, holy crap, I'm not paying taxes with this.
Well, let me show you just how fun this is. Okay, you want fun? This is fun.
Yeah,
let's go.
Okay, and it's easy. Okay, so when you buy a piece of property, just consider what you're buying. Right? You buy land.
Mm-hmm.
Right? You buy a building. You buy the land improvements like the landscaping and the fencing and the covered parking, all that kind of stuff, and then you buy the contents of the building. Right.
So Jake better make sure that they got the landscaping down tight, because all Jake does is complain about guys who are cutting grass and not doing a good job.
I don't complain. I just fire him if it's not the way I like it.
So. Okay. So now what the IRS, the tax law treats these four differently.
Mm-hmm.
Okay. Each one's different. Okay. Land, they go, well, it never wears out, so we're not going to give you any deduction. So the deduction for land is 0%. Okay. Even the IRS understands that land doesn't wear out. Building, they say it wears out, but it wears out over a pretty long period of time. So if it's a residential, they say it's going to wear out over about 30 years. So it's about turns out to be about 3.6%. Okay. That's how much you get to deduct every year as a proportion of the building. Land improvements, they say, well, those last a little longer. They typically last, 10 to 15 years. So that tends to be somewhere between 5 to 10%. And then the contents of the building, like the carpet and the ceiling fans and the window coverings, that kind of stuff, cabinets, they don't last very long at all. So typically they're going to be 5 to 7 years. So about 20%, right? Now, here's what a cost segregation does. A cost segregation just breaks down your purchase between how much of your purchase is allocated, what percentage goes to land, building, land improvements, and contents. That's what a cost segregation does. Now, here's the magic. 2017 changed the law. This now, instead of 5 to 10% or 20%, is now 100% in the first year. Mm-hmm. So let me give you a simple example. Let's say that you look at these and you go, okay, how much of my property is land? Let's say it's 20%. Okay. How much of my property is building? Let's say it's about 50%. Okay. These are pretty typical numbers. Mm-hmm. Land improvements, you're typically talking about somewhere around 10%, and then contents typically around 20%. Well, what does that mean? That means 30% of your purchase price is a deduction in the year you buy the property. Okay, so let's put this in perspective.
30%, Jake. I see Jake smiling there. So
okay, so
a $10 million deal.
Let's put this. Okay, let's do your $10 million deal. How much are you putting down in a $10 million deal?
30%. We'll be conservative.
Okay, so you're going to put down $3 million, right? Let's use your down payment, and then the bank is going to put in 7, right? Mm-hmm. For a total of 10 million. Right? Now the bank doesn't get any deduction for its contribution. It's just lending the money, it gets interest, that's it. You're, however, going to do a cost segregation, and you're going to take somewhere between 20 to 30%, let's say it's 30, of that $10 million, and you're going to deduct $3 million, or in this case, the amount that you put down, you're going to deduct that in the very first year.
Tom, that's what they call making it rain.
If you're in a 40% tax bracket, that's $1.2 million you just put in your pocket from the government, because that's $1.2 million you didn't have to pay to the government.
Here's the key to life, folks. Get into a state that does not have income tax, low property taxes, nice sunny weather, and do some cost segs on some big buildings, and life is good.
That's
my playbook to life. Marry a good woman and you're good.
Is that what I've done? I've got the woman, I've got the kids, I'm living in Florida, I'm doing cost segs.
There you go. There you go.
Look, we don't gotta make this too difficult. Hire Tom to take care of the rest of it for you and your money. So
you got the whole thing. You know, I mean, obviously there's details and all that kind of stuff. That's why you need good professionals, good team members to do that. You know, and this is, you know, you don't guess at this. That's a mistake, right? The IRS won't allow that. But if you have a professional cost segregation, I mean, you think about that. The cost segregation on this probably runs $20,000 to get a $1.2 million tax benefit. That's a pretty decent return on investment.
Why don't people do it? Because we've bought from mom and pops that don't do cost segs sometimes. What is the rationale?
They don't trust the government. That's one of the responses we got.
It's an engineered study, so you need to do an engineered study.
Here's the thing. How many people step over dollars to pick up pennies? They do it all the time. And that's a lot of what goes on. Well, you know, this is expensive. It cost me $20,000 to do that for a $1.2 million benefit.
And if you're a real estate professional.
So let me show you. The difference is, one of the differences over here in this cash flow quadrant is when people in the E and the S quadrant tend to look at money they spend as an expense. It's gone. People in the B and the I quadrant tend to look at money they spend as an investment. Okay, so if you're thinking of it as an investment, then you want to spend, and you're getting a good rate of return, you want to spend more money because you want to invest more money, right? If you look at it as an expense, you're trying to reduce your expenses. Okay, so again, scarcity and abundance, like you were saying, you know, scarcity and abundance, but at the same time, it's also, is it an expense or is it an investment? And if you look at your team members and people around you as investments, why wouldn't you do this? Now, the other problem is that, of course, you have unfortunately, a lot of accountants who don't understand this. They go, well, that's really aggressive. I'm going, so just so everybody understands, cost segregations are required by the law. Cost segregations are required by the law. The IRS says if you don't do one, we won't punish you because they're happy to get their money, or they're happy to get their money, right? But they are required under the law. Okay, there's no question. Under the law, they're required. So people think, well, that's aggressive, when in fact, it's conservative to do a cost segregation, and it would actually be aggressive to not do one. If you're saying, am I following the law versus not following the law, being aggressive versus not aggressive. So, you know, people don't understand. And the other part is that, you know, again, expense versus investment, your tax advisor, is it an expense or an investment? If your tax advisor isn't producing revenue for you, like tax savings, then it's an expense and you want to reduce that expense. If your tax advisor is producing revenue, you want to spend more and more money with your tax advisor, and you want the most expensive tax advisor that's providing the benefit. Why would you not spend the money if you can get that kind of a return?
Gino, what does our buddy Josh say? If it makes you money, it costs you nothing.
There you go. There you go.
So I think that's what Tom's saying right now.
Absolutely, it's free.
Yeah.